All right. So I think in the last class we did PPE. And I'm sure everyone what is what are the measurement criteria? What items qualify to be part of the cost of PPE? I think these are some of the examples that we did. How do you recognize your carrying amounts? What makes up your carrying amount? How do you determine your depreciation? Are you using the straight line method or the reducing balance method? All of this, I believe they should be, even if you are challenged to write the exam now, you'll be able to write that to a large. So you're welcome. Like I am Bukola. So now we are looking at chapter 7, which is bad debts and doubtful debts. Now, when you, like, I'm sure majority of us here would know one or two things about bad debts, right? Must have heard it before. You are owing somebody now. You say, "This is your debt. This money I'm owing you now." Just take it as a bad debt. So, can anybody tell us what bad debt is? Can anybody say something about bad debt? Hmm?
Bad
Anybody?
debts, those we cannot recover again.
Hmm. Okay. So bad debt is an irrecoverable debt. So as she has said, the bad debt is a debt that we can no longer recover the debt. So that's what I mean by bad debt, right? So so basically we are looking into this and we'll just talk about it and see if there's anything we need to solve, then we'll solve it. Then we can move. Okay, so basically, before you talk about bad debt, something must have brought up the bad debt. Bad debt don't just come, right? Just like most things that happen to human don't just happen. They happen because of action that you took at some point in time. For instance, now, Amarachuku is here. Some other guys are here. Some other people are here. Okay, I want to become a chartered accountant. And that is the reason why you're here. It is a decision. Now, how does it come about that you say, okay, you want to become a chartered accountant? That's why you're here. Sorry, hold on. All right, sorry. So, based on the decision you've taken to somebody, I think that's one of the major places where bad debt comes about, right? When the person now eventually say, man, I cannot pay you. Oh. If you like, if you sue me, you do anything, I mean, I can't just pay you again because I don't have the money or any other thing could have happened. Bad debt comes as a result of sales on credit, right? That's why you see the introduction here. They say business might take all it says, make all it says to be cash, but many business make some or even what they are sales to be on credit. This is often no alternative to offering credit to customers if competitors. So, I mean, some businesses have been forced out of business because you need to sell on credit. So you need to sell on credit for you to be in business. So, and because if you don't sell on credit, I mean, the only organization is the government. Every other organization, all the private institutions, I mean, you have to sell on credit to the company. Thing that nobody else can offer. That's when you can say, okay, I'm monopolizing this, I'm selling I'm not selling on credit. If we look at the likes of Dangote, all of them like that, and the likes of MTN, you may think they don't sell on credits, right? Then, in fact, there's something they call a rebate. Rebate is a way whereby they use it to sell. How does it work? Is that okay? If you sell 1,000 units of this particular product, this will be your rebate. If you sell 1,500 units, this will be your rebate. Why are they doing all of that? It doesn't mean you paid for the money. No, you've not paid. They are trying to push those goods to you on credit so that they can have more sales, right? And they will know that somebody is owing. So that is what's come about. So when this person that you sold to on credit, maybe the person is declared bankrupt or any other thing happened to the person, it becomes about bad debt or a doubtful debt. It becomes doubtful when the person can no longer meet the obligation. And when the person is now saying, okay, there's no way, and you can see that there's no way this person can pay again, it becomes a bad debt, right? So I believe I'm putting it to us the way we should understand it, right? Right. Okay. So if sales are made on credit, there's always a chance that the customer will fall into the financial difficulty and be unable to pay. That's what the whole, right? And it will be misleading to users of financial statement if a business continues to show the receivable. There's no chance, only the slight. Because, okay, for instance, now you want to calculate. So what we're trying to say in essence here is that if you're carrying it in your book that somebody is on you, but does this person still have capacity to pay? If a business has been declared to say, okay, this business have a going, you are still showing it in your book that collect my money from this person. I mean, you may be joking because this business is crashing, right? It's already been declared that it is prepared on breakup basis. I'm sure we've done this, the breakup basis, the cash basis, the, the going concern, the two ways that you prepare financial statement about the longevity, the continuity of the business. Is either it is on breakup basis or it's on going concern basis. The reason why it will be on breakup basis because all businesses have been prepared on going concern basis, but in a situation whereby a business can no longer pay the money, you break up, you have to prepare it on a breakup basis because that business can no longer fulfill its obligation. Now, if you're carrying the good, the value that somebody that has been, a company that has been declared to close down, you're carrying the value in your book and say, okay, this person is owing us, and we put that in our book. By the time you use that to make decision, it becomes an issue because the person will now say, okay, somebody like me now, I take up your financials and I'll put it like, okay, they are owing them this amount of money. With that, can calculate the working capital, then I will see that the working capital is huge because I'm still having your own debt that I know that I can no longer get into my books. So it will be a wrong communication. So the application of the concept of prudence will require that there should be an adjustment to reflect the fact that there are some receivables which the business think that it will not recover. There are two categories of problems for receivable which adjustment might be required. Now, we have bad debt, which is irrecoverable debt, and we have doubtful debt. Now, we're talking about bad debt. Now, bad debt is an amount owed by a customer. Oh, sorry, somebody raised hand. Is it a mistake or the person want to ask a question before I go on? Okay. So no question, right? So let me go on. Okay. So somebody bought goods or whatever service or anything on credit. Business believes that it will never be able to collect. So when the business believes that we can no longer get this money from this, we have to. So it means we have to recognize that as. So the simple thing about bad debt is that this person can no longer pay us. And that's what we are talking about. So that's why they listed it here that in a situation whereby there is bankruptcy or insolvency of a customer, as a debt of a customer who has left insufficient asset to pay off his debt. So, I mean, many things can happen. Now, when there is insolvency, insolvency means you are no longer solvent. What does that mean? Means that you no longer have the capacity to meet your obligation. Simple term, insolvency, less to pay you are owing. That's what insolvency means. So when you become insolvent, it means that your business can no longer pay what they are owing. You can no longer pay staff, employee. You can no longer pay. Can no longer buy raw materials for you to produce your goods. Can no longer carry on your activity. The people, I mean, everything is just stocked. That's where we say, okay, this person is or insolvent. Now, when there is a death of a customer, for instance, now, and the person's assets cannot pay off his debts, then there is a problem. I mean, there is no way we want to recover such money. Let's say it's a one-man business, and even the one-man business, what is left in the business? Let's say it's 100 million naira. Now, this business is owing about 500 million naira. So, how do you want to get your own money back? Obviously, it's going to be very, very difficult for you to get that back. And that's why we want to recognize that as bad debt. Another issue that can happen, that can lead to bad debt, is a dispute with customer over whether a contract has been fulfilled or not. Sometimes uh, some people carry out a particular kind of business. For instance, now you can be asked to, okay, come and carry out, come and help us to build a house somewhere. Now you have that contract, you started it, and and now because some things might not be well stated. Okay, for instance, now they may say, okay, we are going to put interior decoration. Now, if the interior decoration they said they will put when they wanted to start the business, I mean start the building of the house, maybe they can believe the interior part that we're going to do is just the kitchen cabinet. It's just the kitchen cabinet. We've put the AC piping and all of that in the building. Then we expect that the people that owns the house will be the one to do tables, dining in the house. Now, there can be a dispute to say, okay, that was not my intention. If you now carry it in your book that this company is still owing you for that money, and because there is already a dispute between you guys, okay, this is what I was expecting, this is what I got. What I ordered versus what I got, it becomes an issue. Just imagine that you now you pay where we use that in joking leaders and say what I ordered versus what I got. The person that still got you what you did not want to get is still telling you that you are winning. Maybe so many would have shot somebody or say, just leave this earth for me. So those are part of the things that can lead to bad debt, right? Then we have dishonesty of a customer. So, people just my one of my former organization, somebody was telling me there that okay, the guy was just telling me how they right. And what did the person do? The person came and disguised as somebody that wants to buy goods. Yes, person carted away with the goods. And how did he do it? He gave them fake alerts. And the person dressed well, came with big gift. So, I mean, you wouldn't think this person is lying. You want to respect the status, big jeep, look at the way he dressed. So you use that way and say, okay, I've paid. Look at the alert. Why are people not getting the alert? You want to raise voices and okay, don't worry, you can go. This is the person that they've not seen before, but because they feel okay, this person cannot dupe us, say, okay, you can. And at the end of the day, they found that the money was paid. So, now, where did the problem come in that? Now, you cannot put that money in your, because recognizing that in your book. What are you going to do? The double entry principle is that, okay, you must have debited your bank, right? Then you would have credited the value of the goods that you sold to that criminal. Now, the criminal now, he didn't confirm that proof or, there is nothing like this in our book. Then you are saying, but this person say he paid. Obviously, it means that money company ran after the guy. They caught him. When they caught that that's the way I've been doing it for others, and that. I mean, obviously, this will not be able to pay that money. Like they've drag the person. The person just paid maybe like 10% of the money. But the remaining money, obviously, there's no way you can pay it. Your organization is not carrying that in the book and saying that, oh, we're going to get this money because the case is now in a kirikiri story, because this person, if you like, carry police. So those are the cases that make up with bad debt. Now, a doubtful debt is an amount owed by a customer that the business believes might prove difficult to collect, but they still hope to do so. For example, the business might know that the customer is in difficulty, but might be able to work its way out. This casts doubt on the collectability of the receivable, but it might still be possible. So, for instance, like that case of that guy I used now. Let's say the guy, yes, they've arrested the guy. The guy's in police station, but his family now say, "Okay, don't worry, we're going to settle you." You know, there's still hope. But they say, "Bye bye, nobody's even coming. Just take him home. I beg, let him just go with you. Just know that of course, you know that you can't get that kind of money. So it will be wrong for you to put it in your book. But it becomes a doubtful debt when you still believe you can get it, not with word of faith, right? Yes, we have faith, God, but things that, don't just go there because it's not real. So yeah, so then they said examples of circumstances that might lead to the conclusion that that receivables are doubtful include customer experiencing cash flow problems. So when your customer is not having cash flow, that's what we still mean by insolvency. Although in that case they've not been declared, right? But they are still experiencing cash flow issue, or not that they've been declared bankrupt. So they see of customer taking an unusual long time to settle debt. So yes, they might be paying you before 30 days every time they buy anything they buy, right? But now begin to linger. But it is not enough to say the bad for the business. So that's what we're saying. Now, we don't say financial. So a customer experiencing operational difficulties might lead to financial problem. When they're having problems in their operations, they can no longer do things when they're supposed to do it. Maybe there's no electricity and their generator is down. You don't have any other source of of anyway of running the operation. Okay, you can see now they said strikes, natural disaster, disrupting production. Okay, there might even be wind, but there might be heavy downpouring of rain that have affected the business where it is located. So those things will make somebody that cannot work because of strike or because of one thing or the other, How do you expect the person to come and pay you? It's not possible, because it's from the business they will see money to pay you. So say bad debt and doubtful debt are accounted for differently. This thing we are saying, there are two different things, right? Therefore, often there's just often a single bad debt and doubtful debt expense account in the general ledger. So what you're saying is that sometimes we write it together in the book as bad and doubtful debt expense account in the general ledger. So where does prudence comes in? Prudence comes in where a business should not show an asset in its financial statement as an amount greater than the cash that it will generate. When such circumstances arise, the asset is reduced in value down to the cash expected. So in essence, what we're trying to say is that, let me go to Excel. Are we getting it?
Yes, sir.
Thank you. Can see accounting is simple. Huh? Good thing about accounting is every day. I mean, if you're in practice, you will see what you have read in school. You see it in practice. So accounting for bad debts. Sorry, the prudence part, Let me explain that. The prudence, what this prudence is saying is that if a business receivable is 1 million, yes, that's their receivable. Okay, we understand. But then can you actually collect all this 1 million? If it is yes, then your receivable is fine. Yes. If it is no, then there is a problem. No. No means how much can now be collected from it? No, not little. How much can we get from the debtors? You now say, okay, we can get 0.8 million. That's 800,000 naira. Is that fine? Now, this is the amount you can get from that total receivable that you carry in your book. Prudency policy is now saying that recognize this amount you can get. So you recognize this, because that's what you can get, not the other way around. So how do you account for bad debts? So bad debts are receivables that an entity is owed, but that is now expected to collect. I mean, that it does not expect to collect. So when there is a specific receivable that is considered bad or irrecoverable, it is written off. That means it is removed from the accounting system and supporting records. How do we do that? Now, we have certain amount of money that is being owed to us. Now let's come here. Accounting for bad debts. So in a situation where we are accounting for bad debts, initially, what would have happened when we sold the good? We debited receivable, Then we credited sales. This one have affected our profits or loss account. These have affected our statement of financial position. Are we getting it?
Yes, sir.
Aderunke Adedoyin. Right. Okay. So I said in this was the initial entry. Initial entry. Now, we've debited our receivable. A receivable is an item of your statement of financial position. Why your sales is an item of your profit or loss account. Now, we now say, okay, this payable now, this person can no longer pay the money. What do? We now say debit bad and doubtful.
You're not showing
Debt.
the working notes.
Oh, really? Sorry. What am I now? I'm sharing screen. But you can see this one. You can see the pack, right?
Yes.
Maybe I made a mistake where I was sharing. Okay, let me unshare, then share again. Stop sharing. Ask. Can we see now?
Yes.
Yes, sir.
Right. Thank God. All right. So I mean, I said initially, so what this one that I did. So I was talking about prudence. I said in prudence, something is saying that if you have a receivable of 1 million naira, now prudency will now have prudency as a concept that accounting now has to. Your prudency is what will prompt that question and say, are we going to be able to receive the whole of this 1 million? If the answer is that means fine. We can recognize um receivable. I mean, as part of our assets. Now, because now you now say if it is no, how much? How much can we get from the debtor? We now say, okay, we can get 800,000 naira. That's 0.8 million. We now say, okay, it means this is what we can get. It means the remaining 200,000 naira have to be taken out from our receivables. Because, okay, for instance, now let's say I want to calculate working capital. Do we know working capital formula? It is current assets minus current liability. Now, if now my current assets, my receivable of 1 million naira will be part of it. I now say I want to collect 1 million naira. It means I've misled you. If your current liability is also 700, and I say my current assets 1 million, 1 minus 700, it means I'm saying I have 300. But prudency will help us to say, okay, how much can you actually get from it? It is 800. You now come here, put 800. It means that you're going to have a better picture of what is obtainable in your financial. It is 100,000 naira and not 300,000 naira. I hope we are getting it. Or is it doing bye-bye? Talk to me.
No, I'm getting it.
All right, thank you. Okay. So, and I said, in that situation whereby we have certain amount of money that is no longer receivable, we now say credits receivable. Now, it would be right for me to say initially, that's why I put initially here. when we sold when we sold the good, initially when we sold the good, this was the entry that we passed, like we have done in our double entry. It is debit your receivable, then you credit your sales when we were selling that good on credit. Because we sold it on credit, we didn't sell it on cash. Nothing like bad debt, right? Now, because we sold it on credit, we're debiting our receivable and we're crediting our sales. And I said, receivable is a function of statement of financial position. What do I mean by that? It's an asset. An asset is part of items of financial of our balance sheet. Now, in our sales, a major part of our profit or loss account. Now, an asset where we now say, okay, 200,000 naira from that money can no longer be received, or whichever amount. Now, this value that you put here means you have to reduce it. Linking it to this, linking it to this, it means we now debit our bad or doubtful debt, and we now credit our receivable account. What would be the implication is that this value of 1 million that we've debited before, look at this. If I'd see if I have, okay. I'm not sure this one I have all the things we've done in the past. So anyway, so in essence, what we're trying to say is that this receivable was already 1 million. 1 million. Now that we are not crediting something into it, means it will come back to the 800. 800,000. So that's just the logic that we're trying to say here, right? That's the logic we're trying to say in this place. So this one that is broken down here is just like, okay, Bukola is owing you certain amount of money, and Bukola makes up part of your receivables. So how do we now say it? It means that Bukola will now be credited, just like Bukola paid. To be like Bukola is paying. So Bukola will have to be credited, then you have to debit the bad debts and doubtful debts. Tell me something. Is it clear? Which part is not clear? Which part am I not speaking what you want to hear?
Please, the amount
Hmm?
that was paid, amount paid by the customer is what will be credited, right, into the customer's account. Why? What are the receivables and the bad debt? Is it the same amount also?
Hmm? Did I get that question? Hello, can you say that question again? Sorry, hold on. I'm coming. Sorry. I'm back here. Uh-huh. So somebody has a question, right? So who is the person? So you were asking a question about value on bad debt or something. Can I get it again? Hello? Can we hear me?
I can hear you.
So what was the question?
Okay, the question is, if a customer, the sales of, and the customer is owing 100,000, for example, and it made a payment of
Yes.
80,000, and you know that the 20, you can it was pushed to bad or doubtful debts, the 20k, 20,000. So, like I'm saying, that how are we going to treat that? That the You were showing something like the customer's account. Is it the 80k that was paid that will push to the customer's account, while the 20k will be in bad debts and the receivables, right?
No, it's no longer be the 20K. Is it that the person will no longer pay the money?
Maybe there was something like doubtful debt, or there was maybe it's something like, that you cannot recover at that time, and it was pushed to a doubtful debt account. It will be pushed.
Okay. So so in that situation, what you're just trying to say is that okay, you sold to somebody 100,000 naira, the person now pay 80K, no longer able to pay the remaining 20K. How do you treat that in your book? Simple, straightforward. Accounting is sweet. So what you're going to do is that you debited your bank 80,000. You already carried it in your book that 100,000 naira. Hmm? Now you are going to debit 80,000. You are going to credit your receivable. Debit bank 80,000. Credit receivable 80,000. No, credit receivable 100,000. Then you debit your bad debt 20,000. That balance up. You get it. So I'm too fast. This is what I said. Debit, debit, what did I say now? Bank 80K. Debit bad debt 20K. Credit receivable 100K. That's it. Did you get it? Is it
I
clear?
got it. Yes.
Okay.
Yes,
Thank you.
it's clear.
Thank you. So, when a bad debt is written off, it's reduced the receivable ledger to zero and total receivable accounts. Now, so just like I've said, it's just to take out what is not supposed to be part of our book. Looking at this example here, they said the business has a trade receivable of 750,000 naira, but decides to write off a bad debt of 15,000 naira. Just like as we've said, simple, straightforward. What's that instance? The instance here is saying that you sold to different people. Now you have a receivable of 750,000 naira. The prudence in you have made it sure that okay, we have something to be written off of 15,000 naira. Now that's value that will be written off for 15,000 naira have to be taken out from your account. And that is what we've said in this same place. Now, if I'm to treat this now, what do I do? I can usually copy it out, do like this. No, I don't want this. So I copy this out. Control V. Now I want to post this. Here's that my T format. So let me quickly go make it faster. So basically, what we are doing here is that you, as an accountant, what are you going to debit? What are you going to credit? It's simple. You are going to debit your now. Obviously, your receivable already showing 750,000 naira. Now that somebody is now owing you, now that somebody is owing you, or somebody, I mean, we are being owed. Let me do simple. Bam, 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 bam. How do we do this? Say this. So looking at this now, I can say here, I can copy this, put it here. So here I can say bad and doubtful debts. What do I call this? Receivable. Receiving. Now, you already have this in your debit side that you have balance brought forward, or whichever way it is called. You already have this to be. This thing is not. Sorry, slow. Anyway, so this is debits, credits. Now you already have this to be your balance brought forward to be 750. That's what they are saying. So the 750,000 naira. Now, the question is not saying the business has a trade receivable of 750,000, but decide to write off a bad debt of 15,000 naira. Now, the bad debt written off will be credited here, and you say bad debt written off. How much? 15,000 naira. It means you are going to have balance carried down of this minus this 735,000 naira. Then you close the account here. Put in this figure. Pim pim. Then you put the same thing here. So the account is balanced. Then you have your balance brought down to be 735. So this is your closing balance. Now, which you used to open for the next period. Now, if I copy this same thing, copy this, put it here, right? Let me put one space. Insert, shift, right. Okay. Now this is another account called what do we call this? Bad debts and doubtful debts account. So this is it. Now, in essence, what we are doing is that We're not saying that. Now, this one will not have any balance brought forward based on the question. What we're going to have here is just going to be, now, this one we've debited it in the, we've credited it in the receivable account. It means we are going to debit this. Put it here. 15,000 naira. So this is the value that is no longer regarded as what we can recover from these people. Now, look at this here. What do I even want to show? Like, so you look at, what we have, so this is what I'm trying to show. Okay, look at this transaction that we did here. What we are trying to do is to debit the receivable. Debit the doubtful debt. That's what we did here. The 15,000 is debited. Sorry, it's supposed to be receivable. So it's supposed to be receivable of 15,000. Then we credit. That's what we are saying. Credit receivable here. Credits. Is it clear? That's the accounting for bad debts that is here. That's what we just did in that example. Is it clear? It's not clear to anybody. Just let me know. Let me know. Let me know. It's clear, right? Right.
Now, please show the Excel sheet.
Is it fine now? Right. So I want to say something. Say something. Let me hear something. All right. So what are you trying to do here? Let's just move. Now we have doubtful debts. We've done bad debts here. So we've expensed. Right. It's important I tell you that this is an expense, right? It's expensed. And that is why I put it here. This is affecting your statement of financial position. This is affecting your profit and loss. This is affecting your profits and loss. This is affecting your statement of financial position. What's the relationship? The relationship between this and this is that when I debit this value, I've credited this value to profit or loss before. Don't let me go that route. I've debited this to, I've credited this to profit or loss account. I've debited it in the statement of financial. Now, I'm crediting into statement of financial position to reduce the asset. Then I'm debiting this to statement of profit or loss. The next one, it reduces my sales. The sales that have been credited here is not directly inside sales, under expense, right? I'm just showing you the relationship, how it's linked together. All right. Now, on the doubtful debts, it has its own double entry again, right? So the basic double entry principle for doubtful debt. How do I say it? Now, when a debt is, okay, let me look for a simple method. Now, this one is bad debt that has been written off, right? Now, we're now saying something is doubtful. We're not sure, right? Doubtful, the way the English sound. Now, accounting is not using that. Okay, this is doubtful for us to receive. We're not bringing it into our book. We want to record it in our book. What we're going to do in essence is that we're going to have a provision for doubtful debt. Provision for doubtful debt. It's a provision for doubtful debt. We're going to have that in our book. And we're now going to say just like as we've expensed the bad debts, we're going to expense the doubtful debt as well. But then it is now going to be a provision for that bad debt. That provision will be sitting in our um in our book, and it will be carrying that same value that you are recognizing as a doubtful debt. So the reason is because we don't want to be carrying in our book what is not obtainable in the real sense of it. The receivable must stay in the accounting records so that the business continues to chase payments, right? So we're now saying debit bad and doubtful debt expense account. Then you credit allowances for doubtful debt. Know that the allowance for doubtful debt might also be called provision for, okay, that's what I called it, provision for doubtful debt account. That is what allowance for doubtful debt is created when it's set against carrying amount of receivable in the statement of financial position. So what we are saying in essence is that now, let's say this money is provision for doubtful debt. I mean, yeah, I say provision for doubtful debt. It's something that we don't know if we will get again. Let's say that 15,000. Now we have this in the receivable. Now, if it is a provision for doubtful debt, it is not going to affect our receivable. Do you know why? Why? Because we still have the hope that we're going to get that money back. So me as an accountant recognizing it means I know what I'm doing, because we still have the hope of getting that money back. It doesn't mean that what am I going to do in my book? What I'm going to do in my book is that I'm going to say, copy this as well. And I'll put it here. And I'll say, okay, this, oh, sorry. So now this is already fine. Now this one will now be provision for doubtful debts. Don't mind my English. Debts. Now I already have. Now you agree with me that the receivable is a debit balance. Now I want to show that this person may not be going to do in my book. What I'm going to do is that I'm going to say, for me to show the real thing that is obtainable, I will now say I'm still debiting my bad debt and doubtful debt account, which is an expense account, that I'm going to credit my provision for that. Now, my provision for doubtful debt account is part of my liability. It's a liability. It's going to sit in liability. Are we getting it? Is anything clear or is not clear?
It's clear.
Okay. Sorry. Now, that my provision for doubtful debt is in my balance sheet, because the provision for doubtful debt is an adjustment against your receivable. But then you don't want your receivable to show that you can no longer receive that money. That's why we created that provision for doubtful debt. Now, this will now be credited, just like you credit your receivable. You credit this provision for doubtful debt, then you debit your expense. this expense account remains the same treatment under. The only difference is that instead of putting the this 15,000 in the provision, I mean, under bad debt, you put it in provision for doubtful debts under um doubtful debts situation. So that being said, the measurement of allowance. So an allowance is only recognized for a debtor receivable if the business know that the debtor might not pay. Therefore, when a business has information about the financial difficulties that the debtor, it will set up an account for this. In addition, the business with many debtors would know from experience that all each end of the year accounts are in difficulty, but it does not know who these are yet. In these cases, a business might recognize a further general account in the allowance. Know that this business would have to justify this amount. It cannot recognize general allowances as it. This must be verifiable. So what they're saying in essence here is that you don't just assume that certain number of people will not pay you again. No, you must be able to justify why and what makes them in that scenario. So look at this example here. Said measuring allowances for doubtful debts and the Accio Coca-Cola, Accio Cocoa Company has received the end of the year 1.5 million. It has carried out end of the year review of its receivable and discovered that the customer owing 5,000 has suffered a fire at their factory, which stopped the production for 3 months. Chief accountant believes that this casts doubt on their ability to pay their debts. I mean, it's um certain amount of money, but then you heard that they have a fire outbreak. I mean, it's insane of you to say, okay, I beg, when are you going to pay us the money now? Now there is fire in your place. It becomes unreasonable for you to be able to do that, right? Now, so we're now saying that it's in practice, Akio Cocoa Company to recognize an allowance of 5% of its receivable. This is based on experience and treatment has been approved by the company's auditor. So this is just the Akio Cocoa Company practice. So this is just an example, right? But then it means we are just trying to say what is the justification for you to recognize a provision for um, doubtful debts. So this will be a justification. There's a fire outbreak, or from history. That's why you see some organization. I mean, there's no multinational environment that you work. You will see that there's something we call ECL, expected credit loss. So you put that adjustment, you make that adjustment in your book. That is because we are not sure all of these people will pay. And that is why they are saying here that Akio Cocoa Limited, their policy to say 5% of the receivable will be recognized as a doubtful provision for that particular year. So they believe that 5% of our receivable will no longer be able to be gotten back. They are good. So that is it. That is what we mean. So all of this treatment is just to show the movement of what we have done earlier. So allows for specific receivable, 75,000 has been. So the 75,000 naira, 1,425,000, that's the balance. Then you have the 71,000 naira, 250 because of the 5% policy. So total allowance that will be required is the addition of the the 75,000 naira and the 71,250. But ordinarily, even when there is no fire outbreak, because of this 5% policy that they have, because of this 5% policy that they have, we are going to would have done this for Akia Cocoa Limited, Akia Cocoa Company. This value would have been taken out of the 1.5 million. But because we have another specific customer that suffer fire outbreak, then we are going to take out some 5,000 naira, which the person is owing us. But now it is no longer like we are taking it. It's not like as if we are taking it from a receivable completely. We are just recognizing that in a doubtful debt. So then changes in allowance accounts. So all of these are just example. So I'm sure we will see more examples in the ICAN pass question. So these ones are just changes to different bad debt expense accounts, allows for doubtful debt. So all we've done is still boils down to all this debit and credit entry, debit and credit. So getting that debit and credit entry is just any question on this area will involve both bad debt and doubtful debt. This is the best seen with an example. So here they are saying a business trade has 75,000 naira trade receivable. It identifies that 5,000 of these debts are irrecoverable and should be written off. So 5,000 naira is irrecoverable. Debits your bad debts and doubtful debt expense account, 5,000. Credits your receivable with 5,000 naira. That's the one. Then allowance of irrecoverable debt of 2,000 naira should be created. It is the first time that the business has opened such an account. So it means that in our allowance of bad debt account, this is now showing that so this one we've debited the receivable, bad debts and bad and doubtful debt accounts with 5,000, and we've credited receivable with this value. Now, the now said an allowance for irrecoverable debts of 2,000 naira again. So you still do the same thing. Debit your bad debt accounts and credit your receivable accounts with the same figure. So they say it has not been done before. It is the first time that the business has opened such an account. So what that means is that I think they made a mistake here because it's an irrecoverable debt. So it is directly on your receivable. So maybe they are saying, okay, an allowance for irrecoverable. So because it's an allowance, there's an allowance here, allowance for irrecoverable, meaning that we are creating irrecoverable allowance. So that will not affect your receivable here. It will not affect this your receivable. It will only affect your provision for doubtful debt, as you've done in this example here. Like I said, your bad debt provision, your bad debt will affect your receivable, while your doubtful debt allowance will affect your provision for that. Right. So those are the entries they try to put in here, and that is it. Right. So this year two, the same thing continues. They're just trying to say, okay, year two, there's a credit sales of 200,000 naira. How did you put that in your book? Debit or when there's a credit sales? Yeah, somebody tell me. Double entry principle. When there's a credit sales, what do you do? Oh, oh, oh yeah, now talk to me. When there's a credit sales, what do we do? Nobody. Are we there? Hmm. Hello. Nobody can hear me again. Can anybody hear me? Right. Nobody's talking. Okay. All right. I'm listening.
Okay, when there is credit sales, they debit your.
Sorry, I can barely hear you. Huh?
Okay, can you hear me now, sir? Okay, like this.
No, my volume is on 92, so I could barely hear you.
Okay,
Sorry.
what
Yeah.
about now? Is it better now?
Oh, it's great now. Great now. Great, great.
Okay, you said the double entry when there is credit sales, and I said when there is credit sales, we debit our receivable account, then we credit our sales account.
All right. So that's cool. Then receipts from customer were 158,000 naira and bad debt written off of 8,000 naira. What will happen to that? Can you try? Receipt of 185,000 naira from customer. Do you know what that means?
Yes, the customer paid 185,000.
Exactly. So what do you do?
Then in that case, we need to we'll credit our receivable account, then we credit the customer's account. No, sorry, the is it the bad debt
You are
account?
crediting two things already. No, no, no. Just do this first one first. Receipts from customer
Okay,
185,000 naira. You do this one first.
yes. Okay, receive from customer. That means we'll credit our bank, then we'll debit. I'm sorry, we debit bank, then we credit receivable.
Thank you. Now, when there is not bad debt written of 8,000 naira, what happens?
Bad debt of. Come again, sir.
Can you see the screen? Bad debt of 8,000 naira written off. There's a bad debt written off of 8,000.
Yes, I can see the screen. Okay, in that case, um,
No, don't stress it. Don't stress it. The bad debt is an expense, right? Debit it. Then
okay,
you're
we
going to
debit the
credit.
bad debt. Yes,
Yes. Then you credit what?
then we credit our receivables.
Your receivables. Yeah, correct. Out of this 200,000 naira, this
Yes,
person pay 185. It means
yes,
we're having 15,000 naira remaining.
15,000. Yes, sir.
Now, out of the 15,000 naira, this person can no longer pay this money. It means they have to reduce it to 7,000. It's meaning 7,000 naira, right?
Yes, sir.
By debiting the expense account, bad debt account, and you're crediting your receivable, it's reduced 5,000 naira. Now, allowances for irrecoverable debts, allowance for irrecoverable debts, right, is to be reduced from 2,000 to 1,500 naira. So 2,000 naira before. How do we recognize that? We are debiting the bad debt, uh, bad and doubtful debt account, the 2,000 naira before, then we credited provision for doubtful debt accounts.
Okay,
Now, we are now reducing that to 1.5. It means we are now uh, credit your doubtful debt, I mean bad and doubtful debt account, which is an expense. We credit it with 500. That will then you're going to credit me, you're going to
Debit.
500 naira. Look at, let me see what it did here. You can see, you can see what it did. You can see the 500,
Okay.
you can see the 8,000 naira. I mean, something is simple now. You can see, allow for that to debt. You've credited this, you come back and debit this 1.5, I mean 500 naira to bring it back to 1.5, which is the 1.5 they are talking about here. Who say accounting is not simple? Accounting is just so simple, easy to do. Hmm? So all of these are just further examples. So there's a practice question to do, right? Doubtful debt recovered. So when you receive, what happens? You are going to reverse what you've done earlier, which is that you debited your doubtful debt account. So you are now going to credit your bad and doubtful debt account back. Then you debit your provision account. That would have nil what you made as provision in your book to be zero, right? You now put the actual amount that you're able to recover from your customer, debit the value you receive into bank, and credit your receivable account, because money has come in from what we expected to receive. So it's just, there's nothing special in that. So we have what we call, have we heard of receivable analysis or payable analysis, aging? Have we heard of aging analysis before? Anybody? Aging analysis.
No. So,
Okay. So what we mean by aging analysis is showing that it is showing the period, the number of days that somebody is, I mean, a business is owing you, or that you are owing the particular business. So we now narrow it down to what we call aging receivable analysis and aging payable analysis. So the receivable analysis is now showing that somebody is owing us 1 million. How long has this person been owing us? Less than 30 days, up to 30 days, more than 30 days, more than 60 days. It is showing the period that is making this. Will give you the position of, I mean, okay, you see that somebody is owing you now for like 1 week. You cannot compare it to somebody that is owing you for over 3 months. You will feel the person that is just owing you now, you will have the confidence that, oh, this person will pay, right? But the person that has been owing you for over 180 days, you will be like, man, it takes grace of God for us to get this money back. So that's why we talk about age receivable analysis. So preparing age receivable analysis is a method of attempting to assess the likelihood of a bad debt, to make an assessment of doubtful receivable. This is analysis that for each individual credit customer of their total debtor balance, showing how long each invoice has been outstanding. So you can see we have customer XY, we have credit limit 20,000, 50,000, you have total 5,000, 2,700. Now, when you had this 2,500, 2,500, and 3,000 together, sum up to this 5,500, right? That's what the person is owing. But then he's owing this for 30 days, less than 30 days. Now, this one is between 60 and 90 days, meaning that the person is owing us for nothing less than 60 days or less than 90 days. Look at this. If you had these three together now, it gives you 2,700. This 27 means the total the person is owing. But what's the position of each of the payment that this person, I mean, each of the amount this person is owing? We now say 1,000 is 30 to 60 days. So meaning that this person is owing us between 30 and 60 days. This person is owing us 1,000. If you go if you use softwares, you use different softwares, you will see that there are different things you can do on those apps. What is receivable, pay, aging analysis. It will show you all of those things because when you put in that invoice, when you debited the receivable and credited sales, it should have captured that invoice. That invoice is captured means that it will start counting the days that the invoice was entered. So if the person did not pay you for those periods, that will show, right? So that's what we mean by aging analysis. There's another one called payable. Instead of this receivable, it will now be payable. That one is considering people that we are owing and how long we have been owing them as a company. If a customer owed an amount, has owed amounts outstanding, this should be investigated and be attended. So what we are just basically saying is you want to pay more attention to this one that is owed or from these 60 days of why these people have not been able to pay, then that will give you the condition. I mean, that will give you the mindset to say, okay, or maybe we have to allowance for that bad debt. But most organizations usually do ECL, expected credit loss. So that will take such instance, right? So summary, this is a summary of the whole thing. So it's just pretty straightforward. So that's the whole about. So I can, so I will send this practice question one to the group, and I'll look for one or two questions in the past question that relates to this. Then I'll send it to the group. We're going to solve it, and I'll be expecting responses. So you all, thank you for joining. Do we have any questions so far? So good.
Please, can you explain the aging analysis again?
So aging analysis is a report, the amounts that customers are owing you or that you are owing. So there are two aging analysis. They are into two. There is receivable and there is payable. Hmm? Now, what each of them is showing, for instance, the receivable showing the name of customers that are owing you and the duration of times that they have been owing you. That's what we have in aging analysis reports. The basic thing you have in any aging analysis report is the name of the customer, the amount the customer, and the duration that the the customer is using to hold you for each of those amounts. So, for instance, have you can sell to Bukola, you sold to Bukola, and different invoices, right? Bukola have paid some, Bukola have not paid some. I need to look into it. Okay, which one have Bukola paid for? Which one have Bukola not paid for? Bukola have paid for this one in the one he has bought over 180 days ago, he has paid it. But the one that, I mean, 180 days, he has not paid it. The one that is between 60 to 90 days, he has not paid it. That is aging analysis. The place you put them, that makes it aging. Aging means getting older. Getting older. That's what we mean by aging. Aging is like you are advancing. You are advancing. So as the money the person is advances, you are showing it in your aging analysis report that okay, this person is owing me this for this time frame. This person is owing me for this period of time. That's what we mean by aging analysis. Payable, there is receivable. So that's what aging analysis report is all about. Is it clear?
All right.
Thank you. So, any other question before we call it a day? No question? Right. So thank